All right, today we are diving into an absolute classic. We're going to distill the core wisdom from a book that Warren Buffett himself said was, quote, by far the best book on investing ever written. That's right, we're talking about Benjamin Graham's The Intelligent Investor. Let's jump into the ideas that literally shaped the world of modern finance.
So, who was this Benjamin Graham guy anyway? Well, you can think of him as the original financial analyst, a truly legendary investor, and without a doubt, the father of a little philosophy known as value investing. His ideas, they've been guiding smart investors for almost 100 years.
And look, you don't have to take my word for how influential this book is. Just look at its most famous student, Warren Buffett. This book was so critical to his success that he still calls it the single best roadmap for investing. I mean, that's a pretty serious endorsement, right?
Now, Graham's big idea, it kind of flips what most people think about investing completely on its head. He argued that being a great investor has almost nothing to do with your IQ. It's not about being a genius. Instead, it's all about your temperament, having the emotional discipline to build a solid framework and not let your feelings get in the way.
And that leads us to maybe the most important distinction Graham makes, something that anyone, and I mean anyone, putting money in the market absolutely has to understand. And that's the huge difference between being an investor and being a speculator.
These two approaches are like night and day. See, an investor, they dig in, they analyze the actual business, figure out what it's really worth, its intrinsic value, and their main goal is to keep risk low over the long haul. A speculator, they're basically just gambling. They're betting on which way a price will wiggle in the short term, chasing market hype, and they usually take on massive risks, hoping for a quick buck. One is about patiently building wealth, the other is about frantically chasing.
To make it crystal clear, Graham came up with a simple three-part test. For anything to be called a real investment, it has to meet these three criteria. You have to do a thorough analysis. It has to promise safety for your original capital, and it has to promise a decent enough return. And this isn't just a friendly suggestion, it's a hard line in the sand. If it doesn't pass this test, then by his definition, it's pure speculation, period. Okay, now for what might be the most brilliant and famous lesson Graham ever taught. To help us get a handle on our own emotions, he came up with this fantastic little story. A parable about a very, very strange business partner he called Mr. Market. Just think about that for a minute. What if the stock market wasn't this big, faceless thing, but an actual person you had to deal with every single day?
So the story goes like this. Imagine you own a piece of a business, and you have a partner, Mr. Market. Every day, without fail, he knocks on your door, and he quotes you a price. He'll either buy you out or sell you his share at that price. But here's the catch. His mood is, well, let's just say it's all over the place. You see, Mr. Market is basically manic depressive. Some days he's just bursting with excitement, totally euphoric, and he'll offer you an insane price for your shares, way more than they're worth. Then, other days, he's in a deep, dark depression, convinced the world is ending, and he'll offer to sell you his shares for practically nothing.
So how in the world do you deal with a partner like that? Well, for the intelligent investor, the job is actually really simple. You use his wild mood swings to your advantage. When he's in a panic and offers you a bargain, you buy. When he's giddy and offers you a ridiculously high price, you sell. And what about all the other days? You just ignore him. You just shut the door. You never, ever let his mood dictate your own.
This brings us to the final crucial pillar of Graham's whole philosophy, what he called the central concept of investment. This is your ultimate defense, your protection against bad luck, against your own mistakes, and of course, against Mr. Market's worst days. The margin of safety, this is the bedrock of everything. And it's so beautifully simple. Only buy something when its price is way, way below what you've calculated its real value to be. You figure out what a business is actually worth, and then you insist on buying it for a lot less. That gap, that's your margin of safety. It's your cushion against all the things that can and will go wrong. So think about it like this chart. You do your homework to figure out a business's intrinsic value, what it's really worth. That's the tall bar. Then you look at the market price, the short bar. That big gap between them, that's your margin of safety. The wider that gap, the safer you are and the more potential you have for a great return. It's a safety net that protects you from a crazy market and maybe even more importantly, from your own human error. So, when you take a step back and put all these pieces together, the mindset, the framework, the discipline, what you realize is that Graham's message is just incredibly empowering. Because at the end of the day, the biggest dangers in investing, they aren't out there in the market. They're in here, inside of us. Graham teaches us that our own emotions, our impatience, our fear, our greed, Our urge to follow the herd, that's the real enemy we have to defeat.
And that's really the ultimate takeaway, isn't it? You can't control the market. You'll never be able to control the economy, but you can control yourself. By choosing to be an investor, not a speculator, by making Mr. Market your servant, not your master, and by always demanding a margin of safety, you are the one in the driver's seat of your financial life.
So, I'll just leave you with this one question to think about. Who's in charge of your financial future? Is it you or is it Mr. Market? As Benjamin Graham showed us, that choice is and always will be entirely yours.